Good morning to you all. Please, you are welcome to SND Professional Institute. Yes, my name is Steven. Please, I would like to show you something quickly or briefly. Now, I will entreat all of you, okay, to kindly do subscribe to our YouTube channel. So this is how you do it. So quickly go to YouTube. So please, I'm sharing a screen now. So go to YouTube. YouTube. Good. Now when you go to YouTube, then you search SND Professional Institute. SND Professional Institute. Now, this is SND Professional Institute. You search for the video you are looking for, okay? So you are doing advanced taxation. So please, this is analysis, PSA. Central government, so it's PSA. We have ICSND, conceptual framework, PSA. You have business income, advanced taxation. You are doing advanced taxation. So you go. So remember, this is our logo, SND, as you can see boldly there. Can you see that? So all what you have to do is to what? Press the subscribe button. You understand it? When you press the subscribe button, this is the subscribe button. It's directly under the video. Are you okay? It's directly under the video. So it's directly under the video. Okay. Thank you very much. So please, I would like all of you to subscribe. Okay. So now the advantages of subscribing is that anytime I upload a video, you'll be notified. You understand? In fact, if you like, you press the bell. There's a bell there too. And the more you subscribe, the more you encourage me. When you finish, you can leave your comments. You understand it? When you finish, you can leave your comment. Don't leave a comment like, can you share this? Like, it's nonsense. Who is that? Nonsense. Don't mind this person. Good. So leave a comment, okay, regarding the video. You understand? Perfect. Good. So that is that. So today, let us go directly into the question. So let's begin without wasting time. I read. The following extract relates to the financial data of Theory Limited, a company resident in Ghana with a basis period from January to December each year. The Theory Limited has submitted its tax returns to GRA for 2020 year of assessment. The truth is that you will get this as your question one. Are you okay? You get a question on business income as your question one. Okay, and if you are fortunate, you might get a question on corporate tax, computation of what? Corporate tax. I hope you understand. And it's very simple. Okay. It's very simple. So this is the second meeting. We'll solve more questions on it because this is going to be question one. And you need the confidence. Once question one goes well for you, the rest will follow that. So that's why I'm wasting so much time in revising business income with you. Are you okay? Perfect. So let's continue. So we have sales. We have cost of sales. We have gross profit. We have other income. So we have other income. You understand? Remember, other income is not related to the core activity of the business. Hence, if you want to find your business profits or business income, the other income, no, it's not supposed to be part. But if you like, you can leave it. However, that's not what I'm talking about now. You have less expenses. So these are the expenses. Then you have other information. These are the other information. You always be giving other information. Are you okay? So determine the required. Determine the tax payable for 2020 year of assessment. Determine the tax payable for 2020 year of what? Assessment. Solution. So you have Theory Limited and line it. So like I told the other day, always try as much as possible to write the words, the basis period. So basis period is the what? The year involved. So it is 1st January 2020 and it will be up to 31st December 2020. Thank you so much. Underline neatly like you are saying. Then write. The question says what? Determine the tax payable, right? Determine tax payable. So right. Computation of tax payable for 2020. You won't have this question. If you don't have it, I've already considered it. It was an assignment to the group. So if you don't have it, it means you join late. Don't worry. After the class, I'll repost the question again. Are you okay? Perfect. And if this is your first time of joining S&D Professional Institute, our free dawn class, then you are welcome to S&D. We are a community of dedicated facilitators who ensure or do everything within our means to ensure students pass. Are you okay? Good. So please, always, this is the assumption. Listen to the assumption. See yourself as an auditor, tax auditor for that matter. Now, when you go into a company to go and audit them, the first thing you call for is the financial statement that the company has prepared. Because by that time, the company has already paid based on the accounting profit, based on the company's accounting profit. The financial statement that the company prepared, they have calculated 25% of that profit and they have paid tax on that profit. So when you, the tax auditor, go into the company, you have to call for their financial statement. Is somebody hearing me? Call for their financial statement, go through the expenses. If there is any expenses that they were not supposed to treat as an expenses, you have to audit. Are you okay? So simple like that. So you have been given the opportunity here that, hey, audit theories limited financial statements. So please just go through the expenses. You understand it? If there's any expense that they were not supposed to treat as an expenditure, but they treated as an expenditure, you have to do what? Edit back, full stop, and no. Also go through their what? Their revenue. If there's any revenue that they were not supposed to treat as revenue, deduct it. As simple as that. That is all. And you'll be giving additional information because in the course of your audit, you'll be asking them questions. You ask them, so this one, how is it? And they will give you information based on your questions. So they have given you additional information. This additional information will just apply the principles of what? Taxation, and you are done with it. Are you okay? Perfect, perfect. So that's the concept. So this question that they've given us, if you go, take their total what? Net profit. Take their net profit. Take their net profits or profits before taxation. Take their profit before taxation. Okay, that is what you are going to adjust. You are going to always look for the net profit. Sometimes you don't see net profit. Sometimes you see chargeable income. Sometimes they'll say chargeable income. Chargeable income means that the income on which I will charge my the same as the net profit. So if a question is given to you and they give you net profit, fine. If they don't give you net profit, they'll give you chargeable income. It's the same. Are you okay? It's the same. Perfect. So let's take the net profit. Net profit is what? 2421620. Okay, please don't write. After the class, I'll give you the slides. Okay. Net profit is what? 2421620. Please, if you have not subscribed, kindly subscribe to our channel. Okay. God bless you. This is the only way you can also show appreciation to SND. Perfect. Good. So now I'm done. So this net profit, I have written it down. Always write the net profit. Good. Yes, Chief. Kindly unmute yourself and talk, please.
Can you kindly? Yes, sir. I'm asking that if you'll be kind enough to increase the font size small for me, sir.
Oh, okay. Very well.
Thank you, sir.
Is it okay now?
Yeah, it's okay, sir. Thank you.
Very well. Thank you. You're welcome. So that's the net profit. If somebody's writing on my screen, let me. No. This is one occasion. Good. So I've written a net profit, right? Now let's proceed. So go to the next one. After you have written a net profit, go through the income. and see if there was anything they were not supposed to add as income, but they added. If that being the case, reverse it by subtracting. Now, sales is correct. Cost of sales is correct. Gross profit is correct. Other income, please. Other income. Anytime you see other income, it means that other income could be any other income. It could be income from insurance company, income from insurance companies, right? It could be income from you selling your assets. Other income could be any other income. So please, other income means that income that is not directly related to the business of the company. Are you okay? So with other income, subtract it for a net profit. Do you know why you're subtracting it? You are subtracting it because it's not directly related to the business. First of all, you want to find your business income. After you find your business income, you can add back any other income. So you can first of all subtract, then later add it back. After you have been able to identify the business income, you can add back the other income. Or if you like, if you don't want issue, you can leave it. If other income is there, it's not wrong. You understand it? But what people do is that they will subtract it and later add it back. When you subtract, you get one tick. When you add it back, you get one tick. So why don't you do same? Let us subtract. When you finish computing the business income, we do what? We add back. Are you okay? So subtract and add back. Are you okay? Good. So subtract and what? Add back. So 240. So let's go. Less other income. Remember, we are working with time. So speed is the rule of the game. Speed. Let's go. So these are the expenses. Let's go through expenses on the face of it. On the face of it, administrative cost, selling and administrative cost is an allowable expense. Depreciation is not an allowable expense. Remember, depreciation is not an allowable expense because in taxation, we don't consider depreciation, but rather we consider what? Capital allowance. So wherever I say depreciation, add back depreciation because in the original financial statement, they deducted it. So we will add it back, right? So depreciation, add back depreciation. Please. There are so many ways of presenting this thing on. Your presentation might be different from my presentation, but trust me, the text is the important thing. Staff cost. Staff cost is an allowable expenditure. Advertisement publicity is an allowable expenditure. Directors' fees is allowable expenditure. Repairs and improvements allowable. Donation, penalty and fines. Penalty and fines is a disallowable expenditure. You cannot go and do bad thing for the government to charge you to pay penalty. When you pay penalty, they come and subtract it from your revenue as expenses. No. If you pay penalty, you pay fine. Don't subtract it from your revenue. Don't treat it as an expenditure. Nobody asks you to go and go against the law. Nobody asks you to go against the law. You're supposed to comply. So once you pay penalty and fire, you pay penalty and fire your home. So now let's count penalty and fine. So please, anytime you see penalty and fine, just add it back on the face of it. Don't even think about it. Just add it back, 50K. Even before starting, I've gotten about 40 already correct. Even before starting, I've gotten. So who even says advanced taxation is difficult? Just confidence. Solve more questions, you get confidence. Trust me, that's the only thing. No, once solve questions, sir. You go to examination where you don't even know where to start from. Hey, you think passing is not difficult, but if you are lazy, okay, good, we are done. The following additional information is available to you. So now let's go through the footnotes, okay? Whilst treating it one after the other. So we go. Interest charges. Interest charges is made up of interest on loan for MDs. It's made up of foreign exchange loss. It's made up of bank charges. Interest. So look at this. This 895, 500. Interest. Look at the interest. Any 895,500. Oh, 895,500. This 895,500. This is the breakdown. This is the breakdown. So we have interest on loan for MD. They gave the MD loan and they have brought the interest here. Can you imagine? Can you imagine? Yeah. You get MD loan and you have brought it as a company's expenditure. Nonsense. So that interest now, we will disallow it. True of us. True. No. Interest on loan for MD. MD have gone for loan and the interest on its company is paying. It's possible. No. We didn't ask the MD to go for loan. You have gone for loan for your own personal need and the company is paying the what? So we will disallow this. We will disallow this. So add back interest on loan for what? MD. So interest on loan. interest. Please make a trouble free bill. MD loan. How much? 500,000.
500,000.
All right. Don't go and write plain into grammar. Please, it's the numbers that they mark, not the narration. Good. Foreign exchange loss, yes, it is business related. Bank charges, it is business related. So we are good. Let's go to donation. Look at something. Also, children's home is an allowable expenditure. Okay, it's a worthwhile cause. You donating to also children's home. You have donated to a worthwhile cause. Are you okay? Now, donating to Pastor Azigi Church, nonsense. So is Pastor Azigi. So this one you disallow it. Can you imagine? You have donated to Pastor Azigi. You have donated not. You have donated to the pastor of the church. No. If everybody should be donating to the pastor, do you think anybody will pay tax in Ghana? At the end of the day, and then they will come the money. When you come, they'll tell you that, oh, I donated it to a pastor. No. We will not accept that. Especially that he being a pastor. So this one, we will disallow this. Laboni Senior High is an allowable expenditure. National Disaster Management Organization. That one, when you donate to such a thing, it is such a fund. It is an allowable expenditure. But when you donate to a political party, political party, no. It's a disallowable expenditure. And you donate to a political party, nonsense. So this one, you have to, are you okay? So when you go to donation, you have Pastor Azigi donation, 30,000 plus 90,000, which is what political party, all making 120,000. You have added it back. Maybe I'm done. Go to the next one. An amount of 200,000 disclosed in the account was paid for repairs and improvements. This one. Repairs and improvements. This one. This 200,000 was paid for repairs and improvements. You understand it? Now, anytime auditors are auditing your company and they come across repairs and improvements, anytime they come across repairs and improvements, they apply the principle relating to repairs and improvements. And what is the principle? The principle is so simple. It says that what? The repairs and improvement in your books should not be more than 5% of the written down value of the pool at the beginning of the year. I repeat, the repairs and improvements should not be more than 5% of the written down value of the pool after depreciation. Sorry, after capital allowance at the beginning of the what? Of the year. So at the beginning of the year, no, the written down value of the pool, no, after you calculate depreciation on that particular written down value, no, it should not be more than 5%. The repairs and improvements should not be more than 5% of that value. So what I'm saying is that if this is the written down value, the written down value of the pool, let's say the pool is, let's say class 1. The value at the beginning of the year is, let's say, 100,000. So this 100,000, first thing, calculate capital allowance on it, on this 100,000. Calculate capital allowance on this 100,000. When you calculate capital allowance on the 100,000, so class, you and I know that class 1 is 20%, true or false? Please, you and I know that class 1 is 20%, true or false? Let me meet you. If you think it's true, give me a reaction. You and I know that class 1 is 20%, true or false?
False.
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 Perfect. It means you guys are
False.
learning. Good. So please, it is
40%.
It is 40%. Perfect. Class 1 is 40%. So what I'm saying is that anytime, please listen. They say T-Bofuno. If anytime you see repairs, if they come to the company and they're auditing you and they see repairs, they will calculate, they will go and look for the written down value of that particular class on which you have charged the repairs. So if the repairs is on an asset which belongs to class 1, they'll go to class 1 and go and take the written down value of the pool at the beginning of the year. So at the beginning of the year, what was the balance that you brought down? What was the balance? That balance, now calculate capital allowance on it. After I calculate capital allowance on that balance, no, then charge 5%. Then you compare it to the repairs. You understand it? So if shit. Sorry. That page is not supposed to be. So this is what is happening. So let's say if the repairs is, let's say, 900 cedis, right? Repairs is 900 cedis, and it's belonging to equipment. You and I know that equipment is class 3. True of us, true. Equipment is class 3. True of us, true. So the auditor, first thing that auditor will do, he will not say that, oh, the repairs is correct or it is wrong. The first thing the auditor will do is to go to the capital allowance schedule. Go to the capital allowance schedule. Go and take the opening balance. That's the written down value of class 3. So go straight to the capital allowance schedule. Capital allowance schedule. Go to class 3, the opening balance. Okay, the opening balance. That's what we call the written down value. Okay, opening balance of the class 3. So let's say the opening balance is 100, or let's say 1,000. Well, let's say 1,000. You understand? So when he takes this 1,000, he calculates capital allowance on it. Capital allowance on the 1,000, which will be 20%, right? 0.2 times the 1,000, which will be 200. So you subtract it, you get 800. So this 800, you find 5% on it. 5% of the 800. 40 series. So you compare the 40 series to the 900. The 900 is not supposed to be more than 40 series. The maximum repairs should be 40 series. The maximum repairs should be 40 series. Anything beyond 40 series, they will add it back to the what? To the net profit. Maximum repairs should be 40 series. The allowable repairs should be 40 series. So first stage, find the written down value of the pool at the beginning of the year. Calculate capital allowance on it. Now the answer you get after calculate capital allowance, the remaining value, charge 5% on it. After charge 5% on it, then you compare it. That should be the maximum. Okay, you compare it to the repairs in the financial statement. It's as simple as that. So this particular question, when you read this question, it says that what? An amount of 200,000 disclosed in the account was paid for repairs and improvements of an old machine bought 3 years ago. It is hoped that the performance of the machine will be enhanced after the improvements. So repairs is 200,000. Now, once you see repairs, they go for the written down value of the pool in class what? Old machine bought 3 years ago. They go to written here. They didn't tell us the type of machine. You understand it? So the type of machine will tell us. So when you go down here, you see they say that's what? Here, and here, they are telling you that the machine into bracket pool 3 assets. The machine belongs to pool 3. Had a written down value of 4 million at 1st January. Do you know why they say 1st January? They want to tell you that the value at the beginning of the year, the value at the beginning of the year is 4 million. So the auditor will just go into the capital allowance schedule, go straight to pool 3, go and take the opening balance at the beginning of the year, calculate capital allowance on it, then the balance you get, you compare it, you multiply 5% of it, compare it with the repairs. The repairs in the financial statement should not be more than the 5%. Are you okay? So quickly, let's solve this. So let me put working here. Or do you want to try it? Do you want to try it? So workings. So principle. The repairs should not be more than 5% of the written down value of the pool after capital allowance has been calculated. So the repairs, I'm writing it down, should not be more than 5% of the written down value of the pool after no, should not be more than 5% of the written down value of the pool at the beginning of the year. Let me add that one. Okay. At the beginning of the year after capital allowance has been computed. Good. So the repair should not be more than 5% of the written down value of the pool after at the beginning of the year. Yes, down value of the pool at the beginning of the year after capital allowance has been computed. So in this question, a simple principle, right? In this question, so capital allowance schedule. So we have written down value at the beginning of the year, which is 4 million. You have to find 5% after capital allowance has been computed. So capital allowance, which is 20% times 4 million, which is what? 800,000. When you subtract, you get what? So like I said, the repairs should not be more than 5% of the written down value of the pool at the beginning of the year after capital allowance has been computed. So the written down value, compute capital allowance on it. It should not be more than 5% of this. It should not be more than 5% of this. So 5% of this is what? 160. Right? Perfect. So this 5%, So the repairs in the question was 200,000. Now, the maximum repairs should be this. But we have this. Can you see that? This is the maximum that will be allowed for that particular year. This is the maximum repairs that should be allowed for that particular year. The maximum repairs that should be allowed for what? That year. And this is the repairs that we actually got. So we can't allow all these 200 to be allowable. The auditor will allow only 40,000 to be allowable, right? They will disallow 40,000. They will disallow this. They will disallow this. They will allow 160 of this. But 40,000, they will disallow it. So this 40,000, add it back. Repairs. Add back 40,000. Why are we adding back 40,000? Because it's only 160,000 that is allowed after the 200. The 40,000, they will add it back. Now, any question on repairs? Any question on repairs? Okay. If you have a question on repairs, you can raise your hand. Or you can mute yourself and ask how to compute repairs. Oh, no question. Hey, no question.
Yes, sir.
Yes,
I have a
sir.
question. I have a hand. I have a hand now. Yes. Chief, kindly come.
Yeah, I wanted to ask the donation figure. Can you separate it into two in order to maximize your takes?
Yes, you can separate it into two. But this one too is allowed. Okay, this is how they mark it. They will mark you this, and they'll mark you this. That's how they mark it. Okay.
Oh, okay. Okay. I was thinking
This one is allowed.
separately, and that was okay. All right.
When you separate it, you get your text. No, you get your text. Bro. But the person what you here?
Yeah, I'm not here. Super.
Very well. Very well.
Hello, sir.
Thank you so much. Yes, please.
My question has to do with the donation. You know,
Okay,
we
okay.
have these political figures that they've established NGOs. For example, we have Rebecca Foundation, we have Lodina Foundation, and the rest. So
Mhm.
when you donate to this foundation, is it allowed or disallowed?
As to whether it will be allowed or disallowed, you have to ask the entity you are donating to whether they have been approved by Commissioner General. Are you okay? Whether
Okay,
they
sir.
have been certified by Commissioner General. If that being the case, then it's allowed. If not, there is not, it's disallowed. Are you okay?
Okay, sir.
You see,
So,
most of these
but
foundations are decoy. Okay, most of these foundations are decoy for tax evasion. I believe you understand. So if you confirm whether they have certifications from Commissioner General, then indeed they'll be allowable. Okay,
is it
thank you.
going to be stated in the question that this NGO has
Oh,
been approved?
no. If say they know, they know, they will not cause confusion. So when you read the question, it will be clear. This one will say the fictitious one will be clear out there. Are you okay?
Okay,
Always.
sir.
You see, Ghana something, donation to COVID-19, donation to, you understand it? Then you see the fictitious one, very clear. The BI is like that. Try questions. You see that, oh, with the fictitious one stands out clear. So you don't have issue, you will not have issue with that. For practical purposes, you're fine. But I mean, if you see the name, say this one is fictitious, you know. Trust me, you always know. Are you okay? Thank you very
Yes, sir.
much.
A follow up:
So
a donation to National Cathedral, is it allowed or disallowed?
formally, I would have said it's allowed, but now I can't say, trust me, I don't know now. Now formally, I would have said it's allowed, okay, because it became more or less like a public fund that institutions were donating to. Are you okay? But now, because of the way the whole thing turned out to be, you know, can't pinpoint to tell you point blank that is allowed. But I see the examiner would not bring a national cathedral because it will bring so much confusion. Are you okay? Well, you don't worry. As I'm saying, a bank one with my don't worry. Okay, just solve plenty questions. Good. So let's go to the second one. I jumped to the last one, that number, because I wanted to explain the repairs one. But since you are not, so please repairs, no. This is what majority of you did. Majority of you calculated 5% on the 4 million. You calculated 5% on the 4 million. The idea was there, and I applaud you for that. The idea was there, and I applaud you for that. Okay. But next time, please do what to, first of all, subtract capital allowance from the 4 million. Then you are good to go before you calculate the 5% on the balance. Are you okay? Most of you calculated 5% on the 4 million, which means I was so happy when I saw that. Just at least, you know, there's a 5% rule. But please, the 5% rule is applied after capital allowance are what? Deducted. Good. So let's proceed. Ivan, creditors of the company agreed to cancel an amount of 120,000 standing as part of the credit balance. So you are owing somebody, and the person says that the money you are owing me, I will not take it again. What is it to you? You are owing somebody, and I tell you that I will not take the money again. What is that money? What is the money to you?
It's income.
It becomes an income to you because it was not part of your earnings. So this 120,000, you add it as what? Income. You add it as what? Income. You add it as what? Income. 120,000, add it as what? Income. Are you okay? Good. So let's go. Okay, good. Let's go to the next one. An amount of 3 million being cost price of goods were issued to a related party. An amount of 300,000 being cost price of goods issued to a related party outside Ghana at cost. The margin on the goods waived was cited as 40,000. So you sold goods to your related party. The goods were supposed to be sold for 340,000. But when you sold the goods, because you are selling to a related party, somebody you know, you decided to what? Ignore the profit aspects. You decide to ignore this and just record only 300,000. Because the question says that the margin on the goods waived So you weighed the profit on the goods and you just sold the goods to the person for the cost price. Not just say you left at 40,000. So when GRA comes across this, GRA will add back the 40,000. So as if you recorded the entire 340,000. So margin waived. At the neighbor fool. 40,000. I've got another tick. So you didn't include it, so I've included it for you. Simple. Good. Now, this one, tax paid on account was 20,000. When you say tax paid on account, what does it mean? It means that the tax that the company has paid in the course of the year, the company has made some part payment of the tax. You know that tax is paid quarterly, right? So tax paid on account means that they have paid this tax to GRA already. So this one, assuming the question said that tax paid on account was included in the expenditure, I would have what? Added this back. If they tell you that this amount was included in the expenditure, I would have added this back. But this question didn't say that. They're just giving us information that we pay this tax of 20,000. So this is what is going to happen. After I compute my tax for the year, I will subtract the 20,000 from it because this was tax I've paid. So if I compute my entire tax that I'm supposed to go and pay to GRA, then I'll subtract the tax I have already paid from it. So simple, right? But assuming the question says that, oh, this amount has been included in the expenditure, I would have subtracted it. I would have added it back. I would have reversed it by adding it back. But there was no information to that. So we move. Next one. The company booked capital allowance unutilized, certified by GRA. When you say capital allowance unutilized, what it means is that last year, if my total capital allowance was 900 cedis and I used 800 cedis, I subtracted only 800 cedis. I didn't subtract 100 cedis. Then I didn't subtract the entire 900, but rather I subtracted only 800 cedis. You know that capital allowance we subtract. You see, if it was 900 cedis, when I computed capital allowance, I got 900. But I didn't subtract the entire 900, rather I subtracted only 800 for one or two reasons. You understand? Then it means that I still have 100 cedis I didn't subtract for last year. So somebody would think that, oh, because I didn't subtract the 100 cedis for last year, I can add it to the capital allowance for this year. No. Capital allowance cannot be deferred. Capital allowance cannot be what? Deferred. So if you don't utilize capital allowance for a particular year, you cannot carry it forward to the next year. Are you okay? So the question says that capital allowance booked, the company booked capital allowance unutilized, certified by GRA from 2019 year of assessment to be 300,000. Please, you cannot subtract it. So don't be in a rush and go and subtract this 300,000. You have to leave it. You cannot do anything to it. Leave it. If you didn't subtract it last year, you cannot subtract it in 2020. Are you okay? Because of the word unutilized. That's why I'm leaving it. Because unutilized means that they didn't subtract it for the year. So we will say unutilized for the year 2019. And we have prepared financial statement for 2020. If you didn't subtract it, that's fine. Let's go to the next one. VII. Capital allowance agreed with GRA after taking into account all relevant issues was what? 1,050,000 for 2020. So this tells you that this is the capital allowance for 2020. What the difference between the two? This one, they say that what? This is capital allowance for 2019, which was not deducted. If you didn't deduct it, you cannot deduct it again in current year. But this one is saying that capital allowance for the current year. So it is 1,050,000. So come and subtract capital allowance. $1,050,000. Capital allowance, you subtract, you put it in brackets. Perfect. Let's proceed. Next one, the machine who trade, we have already done it. Good. Next one, an allowable bad debt included in the selling and distribution expenses for 2019 amounted to 100,000. The company recovered the amount in 2020. What does it mean? An allowable bad debt that we allowed last year. Last year, we said that, oh, this money, we cannot collect it. So we treated it as bad debt. Allowable bad debt. So we treated it as bad debt in our books last year because we thought we could not collect it. Now, the company recovered the amount in 2020. Bad debt, we have recovered it, we have gotten a bad debt. So this one, you have to add it back to the financial statement. So bad debt becomes an income to you. Bad debt. You have to add it, recovered. It becomes a profit to you. We covered that. I think 100,000. Oh, recoverable bad debt. How much? 100,000. What you see? Say airbrofu, right? Airbrofu, God. Now let's proceed. Next one. Theory Limited disposed of one of its assets for 250,000 to the managing director. So they sold one of its assets to the managing director for 250,000. It cost the company 300,000. Imagine. You said they bought for 300,000. They sold it to the managing director for what? 50,000. So did they make a gain or a loss? They made a loss because the asset is costing 350,000. They sold it to the managing director for what? 300. The asset is costing 250,000. They sold it to the managing director for what? 300,000. Hence, they made a loss. So that loss, no, GRA will not accept that loss. Nonsense. How can you go and buy asset 300,000 and sell it to the managing director for 250,000? No. GRA will not accept it. Fair. Because you sold it to the managing director, you have reduced the price. No. So GRA will add back the loss. They'll add back the loss. We will not accept this loss. So loss on assets. Disposal. Yes, please.
It's making a further.
Please come again.
It's making a further addition that the value of the market.
Yeah, we will come to that.
Uh,
But then, you see, when they sold the managing director, they made a loss. So let's reverse the loss. Are you okay? So the loss is 50,000. So we have reversed the loss. We have reversed the loss. True or false? True. Can you see that? Good. So let's proceed. So we are done with the first part. Full stop. At the cost of, so it cost the company 300,000 to acquire the assets some years ago. An investigation revealed that the market value of the asset was 350,000. So as at the time they were selling the assets, the market value, as at the time they were selling the market assets, as at the time they sold them asset, the market value was 350,000 and the cost was 300,000. So they will assume that they sold the asset to the MD, the market value, which is 300,000, 350,000, but the cost was 300. So again, we what 50,000. I want somebody to ask me a question here. Say why this and not that. But then again, 50,000. So because the GRA they will assume the right thing to gain on assets disposal. Good.
Sir,
Yes, please.
please, why you did that? Because you have deducted 50,000 or that means I don't understand the
Please,
place.
my boss, you have to understand. Look at something. Bro. Take your time. You understand. Take your time. Let's go. See. Theory Limited disposed of one of its capital assets for 250,000 to the managing director. It cost the company 300,000 to acquire the assets. What does it mean?
Yes, that was for that one. I understand.
So we made the loss, two of us.
True.
Perfect. So GRE will reverse the loss, two of us, because the asset costing 300.
Yeah.
You sold it to somebody for 250. So
Yes.
they reverse the loss. Can you see that? Now let's proceed.
Yes.
So it cost the company 300,000 to acquire the assets. So this is the cost of the assets. An investigation revealed that the market value of the asset is 350. So if you want to sell it, the analyst said you should sell it at the market price. Is that also? Not how much you sold it to him. So the market price, this is the selling price, is 350,000. But in our books, no, we have 300,000 for it. So you have to subtract 300 from the 350. This becomes the selling price and it becomes the cost. So forget the first one. Forget the first one because you have reversed that one. Forget it. So GRA now come to compute the true price and the true profit. So the selling price is 350 because that's the market value. And this is how much it cost us to buy it. So when you subtract the cost from the selling price, you get what? Profit, which is the gain. Do you understand it now?
Yeah.
So that is so GRA, they will reverse it and they'll calculate the real one, the real one. So when they calculated the real one, it's supposed to be a profit and not a loss.
No,
so the reverse
Is it okay to have deducted the 250 from the 350 and record 100,000
No. It's not okay. So this is what is happening. Please, listen. Theory Limited disposed of one of its capital asset, 250,000 to the managing director. So they sold the asset to the managing director for 250. So when GRA comes to the company, they'll ask, how much did you sell the asset to the managing director? I'll say, oh, we sold it at 250,000. Then GRA will ask, what is the cost in your book? They say, oh, in our book, no, it is 300,000. GRA will know that there's something fishy here. So you made a loss instead of making a profit. How can something costing 300,000? You have sold it at 250,000. So GRA what will reverse that transaction. So the loss you made, you add it back. So you forget about how much you sold it to the managing director. Then GRA will do investigation to know how much the asset is being sold for. And a normal circumstance, how much should the asset have been sold? So if that is the case, then they will assume that you sold it to the managing director at the right amount that the asset is being sold for. So the right amount that the asset is being sold for is this, 350. So 350 minus the 300, which is the cost. So the selling price minus the cost price, you get gain. Madam, do you understand it now?
Yes,
so you can't say that you are saying this one is wrong. Then later, if you want to compute, you go and take this one again. If it is stronger, leave it. Now, how much should he have sold the asset for the company? Good. Yes, Chief, can you come in?
Sir, I was trying to ask with regards to the unutilized capital allowance.
Okay.
So does it mean that the ideal situation was that they should have deducted or resulted into a loss where they can carry it forward?
Okay.
How do?
Yes, kind of. You're supposed to subtract everything and make a loss. You understand it? But
So
if you don't
you
subtract
carry the
everything,
loss forward.
perfect. You carry the loss forward. That's if you make a business loss. Okay. But if you didn't, maybe you couldn't compute the capital allowance very well as of 2019 because of that, you realize that if I calculated the capital allowance well, I would have been able to deduct this 300,000 from last year. And the current year, no, now say, oh, okay, then the 300,000, I'm bringing it to the current year. They will not allow you. Any capital allowance you didn't deduct in the previous year, you cannot carry it forward for only capital allowance. But a loss, if you make a loss from your business income, you can transfer it to the next year. Please, are you okay?
Yes, I am, sir.
Perfect. So what you said is correct. Good. So please, that is that. Okay. So that's why we are adding back this. Ladies and gentlemen, let me tell you something. When you add all this, the answer you get will become your business income. Okay. Then you now come and say, add. You see, we learned this one. We learned this 240,000. After I add everything, I now get income from business. Income from business. There's something inside. Income from business. But I would not like you to be writing income from business. Just write chargeable income. Yes, chargeable income before other income. Or business income, the same thing. So please, when you add everything, what did you get? Please, can you add everything for me? I'm waiting for you. So, whilst you're adding, be listening. This is just one aspect of business income. You have other questions that I'll be solving with you. Are you okay? Yes. So, God willing, Wednesday, I'll solve a last question with you on business income. Are you okay? Good. Then, from that time going, we now look at the question 2, which is petroleum. Okay, computation on petroleum, right? So, I just want you to understand the thing very well. Wherever they put the question, at least your 10 over 20 BDA you should get, or your 15 over 20 DA you should get. So be ready for more questions. Let me solve more questions on your own.
Please, I got 414.
No, it's not what you got. Give it to me. Anyhow, I'll write it like that. Give it to me, Badger. Also, you say
4140
4140. Yes.
620.
620. Thank you. So please, if it's not correct, when you go, come complete it also. So you go less. Oh, no. How am I saying less?
You add or you, yeah.
Yes, you add this other income, you less.
Income.
Now add it back. Perfect. Add back other income. So just write other income. 240,000. Good. So please add it for me, madam. Madam, please add it. Madam, what did you say? For what?
438.
438.
0620.
Madam, the truth is that your computation, make sure say correct how. By it's good. It's good. Don't worry. The idea is the most important thing. So now we can compute our tax, right? So tax of 25%. Tax, give it to me. Madam, give it to me. 10. No, 10. 1015. 1015. Yes.
1095.
1015.
109. No one.
Madam, please can you speak out for me? I beg. I mean, your voice is a bit far.
109.
109.
155.
That is
Yes, please.
good. So this is a tax payable. Are you okay? But remember, we pay tax. So tax paid. Tax paid. Or like the question says, this tax paid, the 20,000. Tax paid on account. Tax paid on account. 20,000. So subtract the 20,000 from it. Subtract the 20,000. So tax paid on account is the same as when you see withholding tax. Withholding tax paid on account. So when you subtract, you get 1075. 155. So please, I beg you, when you go, kindly go through the calculation again. You realize that the calculation is not appropriate. But all the same, the concept is the most important thing.
Yes, because the taxable income is not correct. The total is not correct.
Oh, the total is not correct. What did you
Yeah.
get?
464162.
Oh, no. Yanko, yeah. Why? We'll not go there again. So please, when you finish, go and add it yourself. This total, go and add it yourself. So this total will impact the final answer. We are done. Please, we are done. That's why I bring my own answer. So, okay, good. I'm done. Okay, good. I'm done. Any question?
Hello, sir.
Yes, please.
Yeah, that there is please let's go to the footnote. There was an item that was 120,000. I think
Meaning you try the question, right? It's good. This is
no,
it. One
yes.
try question.
He said creditors of the company agreed to cancel an amount of
Perfect.
120,000 standing as part of the credit balance as incentive to the company. This
Perfect.
has not been taken into account by the company in its tax returns to GRA. So if the last part, the last sentence, if it had been taken into account, or if they had been silent, what would have been the treatment?
If they have been silent, you would have treated it the same way we treated it. Are you okay?
Okay.
If they have been
Okay.
silent, you would have treated it the same way we treated it. If
Okay.
they have already accounted for it, then there's no need for us to account for it again. You understand it? If they
Okay.
have already accounted for it. So it's not a question there. And trust me,
Okay.
who said, but what I expect, the question I expected to ask you is that, say, this is the question I expected you to ask me. I don't want to confuse you sometimes, so it's not everything I told you.
Yeah.
what I wanted to, I was expecting to ask him, sir, this amount is not part of the business income. It's not supposed to be part of the income for the business, but rather it's supposed to be treated as other income. What I say, sir, this money is not from our core activity. It's like other income. So I was not supposed to include it here. This 120,000. I was not supposed. Wait. I was not supposed to bring it here, but rather I was supposed to add it. Sir, I've computed the business income. I was supposed to add it as part of this. I was saying the bar saying, the back carry home. Bet your other income 120,000. Do you get it? But all the same, don't worry. That is formalities. Okay. The important thing is the tick. Okay. So you are good to go. That's why I say don't separate it into business income.
Meaning you can still do it like that.
Oh, you can do that. You can do it like that. You can do it like that. That is if you understand it. But the treatment is the most important thing. Are you okay? However, you still get it.
Because
Hello.
the first one we did there, you said
Sir,
it's wrong. I did it like that. But I
sir,
thought I
Oh,
was
okay.
wrong. So
No, it's not wrong. Hey, please, if they're marking, this is how they mark it too.
sir,
This is how they mark. Please, I'm listening.
please,
This
the other income.
uh-huh.
When we are computing, we deducted it, then we
We
come
deducted
back
it.
to add it. Why
Perfect.
not we just leave it when we come? We don't add it, we deduct it from
Perfect.
it.
You are correct
Come.
if you do it that way too.
Oh,
You are
okay.
correct if you do it that way too. You understand? If you like, leave it. That is, if you don't want to do any business income and other income, you don't want to split your income into two streams. Just leave it. That one too is correct. But trust me, if you deduct and add back, you get take here. And you get take what here. How you see that? Two ticks.
Yes, sir. Okay.
Okay, good. So if they're marking, it's simple. This one is supposed to add or is supposed to deduct. It's supposed to add. You get it correct. It's supposed to add. So that's how you'll be getting a tick cent. They will be taking you like that. You understand it? Perfect. We are done. Now, let's go to activity of the day. We continue. Wait. So we have first question. This one is more or less like question and answers, right? Perfect. Good. So we have our first question. Your company, please are continuing. We are done with our question of the day. Your company has recruited 5 new employees, and the director of training has instructed you to explain certain provisions in the Income Tax Act 2015 Act 896 to them. Required. As a tax trainee, explain the following provisions. Research and development expenditure. Please, I want you to explain research and development expenditure. I've been telling you to learn, right? Learn. So please, what is research? Is it an allowable expenditure? What is it? What is the provision? What are the laws say about research and it? So please, when you have such a question, you have to define what research and tell us what the tax provision is about it. I hope you understand. So tell us what it is. So you have to do it. Contribution and donation to a worthwhile cause. Contribution and donation to a worthwhile cause. What is it? What is contribution and donation to a worthwhile cause? What is it? So tell us everything you know about it within a space of 2 minutes. Within a space of 2 minutes, you should tell us everything you know about it. What is financial cost from derivatives in business income? You can't say you don't know about financial cost, right? You should know the principle regarding financial cost. As I prepare for exams, you have to know these things. Are you okay? Perfect. So who can tell me the first one? The first one, please, I need an answer. Research and development. Yes, kindly raise your hand. Yes, please, come.
okay, so research and development is it's a research that has been taken to develop the business or to boost the profits of the business. And
Perfect.
it's an allowable deduction.
Yes.
But if it's disallowable if it's made for the research and development, if it's made for to how will I say to purchase an equipment that is being used for the research and development. That one is disallowable.
Okay, good.
Maybe to
You're right.
buy computer to do a
Yes,
research and
you're right.
development.
You're right. Good. Please continue. Say more.
So with the one that is disallowable, you deduct it from the net profit.
Okay,
But
good.
the other one, it will be added to the capital, the cost of the asset.
Perfect. Good. So you said the one that is allowable, that is from what?
It will be treated as an expense and
Perfect.
deducted from those.
Deducted from what? That's what I want to hear. Deducted from what?
From the, is it gross profit? Yes, gross profit.
You deduct it from the revenue.
Revenue, okay.
Revenue. Okay, perfect. What you have said is correct. So I heard something in what you are saying. You are saying that what? So please, this is how you answer it. You always say that what? Research and development expenses are allowable expenses only if it is wholly, exclusively, and what? Necessarily incurred for the business. That is, if it is business related. Don't go and do research to buy your own private car and come and give it to the company. No. It is allowable only if it is what? Wholly, exclusively, and necessarily what? Incurred for the business. Incurred during the year by the person. You understand it? Or for the business. I believe you understand. That's the first thing that you say. Anytime or anything that is allowable for a business, any expenditure that is allowable, no, it should be wholly, exclusively, and what? Necessarily. When? You understand it? For the business. It should be incurred for the business. So research and development means expenses incurred by the person to boost the company's profits, or expenses incurred for the business to develop the business and improve the products. Research and development excludes expenses incurred that are otherwise included in the cost of an asset. So why do we exclude research and development relating to the one that are incurred in the cost of an asset? You see, when you're going to buy an asset and you incur any research and development, you add that research and development as part of the asset cost. So we don't include it. So research and development expenses excludes expenses incurred that are otherwise included in the cost of an asset used in the process of research. I believe you understand it. Because if you are going to buy an asset like computer for research, and you incur any research in order for you to, maybe you have to do a small research in order for you to know the best computer in the market. That research cost, you should add it to the cost of the computer. Because if it wasn't because of the computer, you wouldn't have carried out that particular research. Are you okay? So they say that research and development expenses exclude expenses related to the acquisition of an asset. It excludes it. Apart from that, in any research we are in, it's so sweet. Any expenses that is incurred wholly, exclusively, and necessarily for the business. I believe you understand it. It's an allowable expenditure. So therefore, research and development that is incurred necessarily, wholly, and exclusively for the business should be what? Treated as an allowable expenditure, meaning that it can be deducted from the what? The income of the business. Research and development means expenses incurred by the company in the process of developing the company's business, or in the process of what? Increasing revenue of the business. I believe research and development does not include any expenses. Then go to the next one. Contribution and donation to a worthwhile cause. You have to tell us what a worthwhile cause is. You understand it? What's a worthwhile cause? Tell us the rule surrounding donating to a worthwhile cause. Tell us everything you know about it. They have financial cost from derivatives. So please, the answers are here. Contribution and donation to a worthwhile cause. A person claim a, please go and read it. What's a worthwhile cause? Examples of worthwhile cause. Full stop. Then the financial cost. It should not be more than what? The financial cost you deduct from your financial statement should not be more than what? The financial gain plus 50% of adjustable what? Income. Is that also? Yes. Exactly. So that is what they want. But tell us examples of financial cost, and tell us everything you know about financial cost. And that one alone, you are getting how many marks? 4 marks. So please know all the principles. Last time we did bad debt. We did bad debt. Today we are doing these ones. So know them. Don't learn it because you want to go in. You are expected to meet it in exam. So, but it's actually a shame for a chartered accountant. Chartered accountant too. But you don't know this. Seriously. No, seriously. You don't know what a work course is. You don't know what the principle surrounding donation to you don't know. So please make sure you learn that. Now let's proceed. Next question. Question B. Trincao, Ghana, branch of Trincao. So please, when you hear branch, one thing that should come in your mind is what? The branch profits. Say branch profits. When you hear a branch, what should come in your mind is what? The branch profits. So Trincao, okay, Ghana, a branch of Trincao International declared a loss of 500,000. If you declare a loss, you and I know that you carry it forward for 5 years. You understand it? If you're in the private sector, right? In 2020 year of assessment in its return, which was confirmed by Commissioner General, Trincao Ghana Limited has submitted its returns for 2022 year of assessment, and below are the extracts. Net profits. Few. The following were charged. They charge depreciation. They charge loss from 2016. So they didn't give you the entire financial statement, but they gave you extract from the financial statements. They said that this is the net profits. And they charge depreciation, they charge loss. Then you have additional information. Agreed capital allowance was what? 95,000. And the corporate tax rate is what? 25%. Determine the tax payable. Determine the tax payable. So the tax payable, all what I'll do is to take the what? The net profit. If I take the net profit, I will add back depreciation. I will add back the loss from 2016. Do you understand it? I'll add back the loss from 2016. Why will I add back the loss from 2016? Why will I add back the loss from 2016? You add back the loss from 2016 because if you make a business loss in 2016, you can deduct it for 5 years. So the loss 2016, you can carry it forward to 2017, making 1 year. You can carry forward to 2018, making 2 years. You can carry forward to 2019, making 3 years. You can carry forward for 2020, making 4 years. You can carry forward for 2021. So 5 years will end in 2021. So therefore, the loss from 2016, you cannot deduct it in 2022 because 2022 will be the set year, and the law will allow you to carry forward for only 5 years. See that? See that? Perfect. So let's go. Solution.
Hello, sir.
Solution.
Sir,
Yes.
please, the loss of 2016, can we also assume that it's for only 3 years since you were not given, whether it is for a priority sector or non-priority sector? Can we assume it's
Perfect.
for non-priority?
You cannot assume it to be that. Do you know why? Do you know examples of non-priority sector? Non-priority sector, no, yes, saloon, shoemaker, you understand it? Do you get it?
Okay.
So if you have a branch telling you that what? It is not these small minor companies. Are you okay? The minor sector, no, the minor sectors, no, non-priority sector. But if you have a company, a proper company, an international company coming to launch its presence in Ghana, you cannot assume it to be a non-priority sector. Non-priority sector, shoemaker, this small businesses, no, they are the non-priority sector. Please, are you okay?
Yes, sir.
So to be on the safer side, no, if you see a company, fully fledged company, limited liability company, take it to be a priority sector. Perfect. Good. So this particular way, you just take the net profit. The question is so simple, right? So simple. I doubt, but then they can give you something relating to that. So I have to net profit was 20 million, right? Good. So the net profit, quickly add back. Oh, what am I? Let me delete this one. Delete this one. Good. So that will be between this. Good. Reinforcement one. Let me quickly add back depreciation because depreciation, you always add back depreciation. So they are telling you that the financial statement, they didn't give us the entire financial statement, but they are giving us key point in the financial statement. Can you see that? So I'll quickly add back depreciation, which is 82,500. So depreciation, add back depreciation. You see the way I do it? I'm not going to write add less. No. If it is less, I'll put it in bracket. Depreciation, add back. Add back loss from 2016. Assuming the loss was from 2018, I wouldn't have less it. I added it back. That one would have been a genuine transaction the company did. Can you see that? So add back this one. Go to the next one. Almost agreed capital allowance is this. So capital allowance. Now, look at this. They say Twinkle Limited, a branch of Twinkle International, declared a loss of 500,000 in 2020. So in 2020, they made a loss, business loss. So they have to carry it forward in 2021, carry it forward in 2022. So here they will have to come and subtract the loss. But business loss.
The capital allowance, you didn't put it in bracket.
Thank you very much, my brother. Twinkle loss, 500,000. Good. So now, answer please. Answer.
One nine four
194.
871 40.
God bless you. Chargeable income.
Wait, 194.
No.
No. I'll not change it, please. I'll not change it. I'll not change it. The concept is the important thing. When you Google and add it, the beside one can also know. They there. So that's that. Okay. So we are done. Okay. Good. So let's proceed. So
They added everything on.
charge tax of 25%. My boss, yes, the answer you gave me, just multiply by 25%. Give it to me.
No, sir, please. Hello, sir.
Yes, my boss.
It's wrong, please.
No problem. When you go and do the right one. Okay. My boss, the answer you gave me, give me 25% of it. No, I just want you to get a concept. You understand? It's not necessarily getting the addition and subtraction idea. We can't get it perfect. My boss.
4871
71
71
785.
785.
Perfect. So please, the additions, when you Google and them, okay. And the concept, is the important thing. I'm talking about these ones. So you know why I subtracted the business loss, right? But after, please listen. Listen to the reason why they gave you this question. They know everybody can add back depreciation. Everybody can add back the loss. Okay, that is not a problem. The reason why they gave you this question is for them to know whether you know how to treat branch profit. So this company is a branch. Can you see that? This company is a branch. Hence, anytime, so for a branch, their mother company is in a different country. Their mother company is in a different country, and they have established a branch here. So any profit they make in Ghana, they send the profit to their mother company at wherever they are. Are you okay? So therefore, this is the tax. This is the profit they made, and this is the tax they are paying on the profits. This is the tax they are paying on the what? On the profits. Can you see that? Therefore, the income after tax, they have to transport it to their mother company. So branch profit. With branch profit, because it's a branch, you see the income they will get that they're supposed to transport to their mother company, you pay a tax of 8% on it. Branch profit tracks 8%. After you have paid tax, no, this is the income you got. This is the tax you are paying on the income. So how much will you left with? How much will you left with? You'll be left with 19487140 minus 4871785 times 5%. Times 8%. Do you understand it? After they have deducted you tax, no, the rest of the money that you are sending to your mother company at abroad, no, that rest of the money they'll charge you 8% on the net after tax. So please, what's the answer? This one, if you don't give me correct one, somebody gives it to me. 8%. What do you get?
One 1169.
1169.
228.40.
So this is the branch profit. So he'll pay this tax to the GRA and pay this tax to GRA, this tax to GRA, this tax to GRA. So this tax is what he'll pay to GRA. Please, do you understand it? Hello? Please, do you understand it?
You said what, please? Come again.
Yes, sir.
I'm asking you whether you understand.
No, please come again with the
What I'm saying is that
What exactly?
what I'm saying is that you know, you all know how to compute this, right? You understand
Yes.
to this level, two of us.
Yes.
You all understand to this level, two of us.
Yes, sir. True.
Perfect. Now, when you read this question very well, look at the question. You say that what? Trinco Limited, Trinkau, Ghana, a branch of Trinkau International, a branch, Trinkau Ghana. It is in Ghana. It is a branch. Are you okay? So with branch, they prepare financial statements like any other company. They go according to the Business Income Act. Any principle where they apply. When they get their profits, they charge tax on the profits. And the tax is 25%. So they have charged tax on the profits. Now, my question is, what becomes their disposable income? You see, after you charge the tax, this is the total income you got for the year. You pay tax of this. The rest of the money remained. You got 100. And then scandals. You got this. You got 90 million total income. Total income. You got 90 million. You pay tax. You pay tax of 4 million on the 19 million. You pay tax of 4 million. The rest of the money, who does it belong to? Please, the rest of the money, who does it belong to?
The mother.
The
parents.
It belongs to the parent company.
Perfect. So you have to, because you are just the branch, when you get the income, you have to transport it to you have to transfer it to your mother company. And I'm saying that before you transfer the money, you have to pay another tax called branch profit tax. You have to pay another profit called branch profit tax. And nothing I'm everywhere anymore. When you subtract the tax from the chargeable income, you get the income remain at the end of the year. You understand? The income remain that they are supposed to send to their mother company. And this income remain, you have to pay 8% on it as branch profit. The tax you pay in order for you to transfer the money to your parents' company, it's 8%. And that is what we computed on year. Please, do you now understand?
Yes, yes, sir.
Sir.
I'm just telling you how to compute branch profits. After you get the profit after tax, you now deduct 8% on it. Okay, or you now multiply 8% on it as branch profit tax. And one in America, in your exams, you can go and get a branch profit question. Now, when you finish everything and calculate your tax for the year, subtract a tax from the income or total income for the period or total chargeable income. The balance you get, multiply 8% on it again, and that becomes the branch profit tax.
Yes, sir.
Sure.
Perfect.
Yes.
Yes.
Well,
And that is also deducted from the amount remaining.
No. You see, we are interested in the tax. Are you okay? Yes. So if you want to know the total money they gave to their parent company, you now subtract the tax from the balance. So what if you remember, what did you get? So subtract this from this. What the answer for that? I think I have to do my own thing because 194,871. So when you subtract it, you get
146,153,55.
Good. So this becomes the branch profit. The profit they will send to their mother company abroad. Now, before they send this money, GRO will not allow you to send all this money to them. They will ask you to pay tax of 8% on it. And that is 116,9228. So the question asks you, how much tax are you paying to GRO? This, you pay this and you pay the tax 25%. Now, when you finish, how much are you sending to your mother company? The money you are sending to your mother company will now becomes, you now send this amount, 55, minus the branch tax you paid. Do you understand it? So that's how you get here becomes the money you finally send to your mother company after you subtract the branch tax from it.
Yes, sir.
Yes. So I want you to get the concept well. Yeah, we are done. Let's go to the second question.
So the 8% is it withholding tax?
Yes, it is withholding tax. 8% withholding tax. You have to deduct 8% withholding tax as a branch profit. Are you okay? Okay, thank you very much. It's final. It's final. Right. Good. We are done. Look at the answer they got. And we were getting different answers because you didn't add one. Let's not add one. Okay. Now let's go to the second question. The second question talks about Karma Limited. Karma Limited. Yes, please.
It seems to be your computation is triggered the business loss.
Please, can you speak loud?
Yeah, you triggered the business loss of 500,000.
Yes, we treated a business loss of 500,000. Yes, what about that?
But in the
Any.
Yeah, but in the projected.
For the projected solution, you are not seeing 500,000. Is that the case?
Yes.
Do you think we should treat the 500,000 or not? I'm asking you. Based on your knowledge, do you think we should treat it or not? Please, can you speak? Oh, feel free. Okay. Hello.
Yeah, this is.
Do you think we should treat the 500,000? They said it is a loss from 2020. So, Maxine, do you think we should treat the 500,000? We should deduct it from the income for the year or not?
I think deduct it, but I am thinking otherwise that maybe.
No. Okay.
Someone just pick up the documents and decided to go through not there. How?
Oh no, I just want to see if you understand what we are doing. That's why I'm asking this question. You see, the loss was we made that loss in 2020, right? In 2020, we made the loss. Are you okay? So the Income Tax Act permits us to carry forward business loss for 5 years. Are you okay? So I made a loss in 2020. In 2021,
if it's a priority area.
Yes, if it's a priority area. In 2021, I will deduct it from any income I get. If I don't get any profit for 2021, I'll carry it forward for 2022. Then I will deduct it. You understand it? Good. So we deducting it now. We are assuming that in 2021, we didn't get any income for that year for us to deduct it in it. That's why we have carried it forward to 2022. Mama, do you understand it?
Yeah.
You
So
can also decide. You can also decide not to deduct it. But your assumption is that your assumption will be that in 2021 we got enough income for us to deduct the loss from it. So therefore, assign in 2021. That's why we know deduct in 2022. But we deducting in 2022 means that in 2021 we didn't get enough income for us to deduct the 500 from it. My boss, are you okay?
I've gotten it, but do we also suggest that they have considered the 500,000 business loss, or they've taken the the whole business as the non-priority type? That is why they couldn't.
No. Forget the non-priority. If you
No, even if it's non-priority, it has 3 years.
Yes, 3 years, and even 3 years into four.
It
I
will
mean,
still fall
2020 to 2022 is still within the 3 years.
So that is not the
How
point.
about you understand it? And I'm saying that with the non-priority sector, please, the non-priority sector, and any saloon so usually they so proprietors. They are the non-priority sector. So the limited liability company, majority of them, and for example, purpose, manufacturing company and all those things, you see it to be a priority sector. In fact, they are priority sectors. Are you okay? So please, let's see why. Please, in order for us not to waste so much time, let's see why they didn't add it. So they didn't add it. They didn't add the 400,000, rightfully so. As you can see, they didn't subtract the 500,000. Let's go to the function. Let's say there was 500,000 loss in 2020. However, there was no intention. There was no instruction in the question with respect to what happened in 2021. We don't know what happened in 2021. Whether they made so much profit that they were able to deduct the business loss from it, we don't know. So therefore, this is what happened. It is assumed that there was enough profit in 2021. That is what the examiner assumed. The examiner assumed that there was enough profit in 2021 to take over the carry over loss. Okay. However, candidates who assumed this loss has not been taken care of were marked correctly. So we are assuming that the loss has not been taken care of in 2021. Therefore, if we carry it to 2020, we are correct. So someone who brought it and someone who didn't bring it, no, we are all correct because the question didn't tell us whether 500,000 was taken care of in 2021 or not.
Okay.
Yes.
So it means that whether it's a branch or a subsidiary, you still carry forward losses for 5 years.
Please, branch and subsidiary, there's no difference. When you're computing tax for them, there's no difference. Do everything the same. The only difference is that with branches, you calculate, after you calculate the tax, you calculate 8% on their profit after tax. Please, are you okay?
Yes.
I don't say.
Yeah.
Very well. So please, let's proceed.
Okay, sir, let me ask you a last question. Sir, in answering the questions, can you be stating assumptions?
Yes, when you finish and you see there's something not very clear, when you finish answering everything, you write the assumption down. Are you okay?
Okay.
Yeah, when you finish everything, you write your assumption down. Like this question, you see, it was not so clear. So you can write your assumption down. And the person marking will understand. Are you okay?
All right. Thank you.
Thank you. You're welcome. Now, I want to see how fast you can be, okay? All of you, the question 2. Kindly we solve it again. I'm giving you only 5 minutes to solve. No, let's do it. Let's do it. Because I know you people, you waste my time. This one that you're not having calculators with you, I don't know how you are going to solve it in 5 minutes.
Yes, sir.
You don't have calculators. Once you don't have calculator, how can you add?
So how? I can do business.
Okay, let's try. I just want you to try something. Let's try. So please, I'm giving you 5 minutes. All of you, question 2. Just question 2. You have the questions on the page. All of you have the questions, or you don't have it.
No problem.
Okay, I'm posting a question right now. I want you to try. Don't look at the solution. Just try it. Don't look at the solution. Okay, I want you to try. 5 minutes. Okay, please stop work. Let's do it together so that you're correcting me when I'm making an error. So, question 2 on reinforcement 1. Question 2 is capital allowance question. So it says that what Kama Limited Comma limited. So let's go. So you have, let me, please. So anytime I give me this question, okay, you're giving capital allowance question. This is how you do it. Look at something. So kindly write the classes. So building is class 4. Plant is class what? Plant and machinery. Class 2. Computers, class 1. Office equipment, class 3. Motor van, class 2. Toyota Saloon, class 2. So as you can see, I have class 1, class 2, class 3, class 4. Can you see that? Let me see. The following assets were bought. So here, class 1, and this is class 3. So still, I'm within class. There's no class 5 yet. On October, Toyota Saloon, okay. The following profits were declared. Okay, good. You are done. So it means I'll make provision for class 1, class 2, class 3, and class 4. Can you see that? Perfect. The class 4, no, if it is 2 or more building, then I'll have to create another class 4 here. But in this case, it's only 1. So I'm done. So we have our cost. Okay, we have our cost. So in our cost, we have computer to be class 1. Computer, only 1. Computer class 1. So I'm saying the company commenced business on 1st March 2020. 1st March 2020. The company commenced business on 1st March 2020. So let's go. So class 1, we have 80,000. Then I have class 2. How much? 160,000. Class 2, 160,000. Class 2, 160,000. That's this one. Okay, 1.6. 1,600,000 instead. Okay, class office building, 2.5. Okay, office building. So I've done this. I've done this. I've done this. Office equipment, 138,000 class 3. Motor van, 220,000 motor van. So addition. 220,000. Toyota Saloon, 180,000. Toyota Saloon car. Addition. Saloon car is a non-commercial vehicle, right? So it's supposed to be maximum 75,000. You're supposed to limit it to 75,000. And you have to answer 25 0,000 138,000. Yes, please add it and put it in the chat box for me. 1,895,000 80,000 capital allowance. Capital allowance. Capital allowance. I'm unmuting all of you since you are muted, so the class is not interesting. I've unmuted all of you. Yes, somebody will ask, say, please, the plant and machinery, why did you put it in class 2 and not class 3?
Yes.
And you said that's the question you asked. Yes, so whoever put the plant and machinery in class 3, you are correct. If you put the plant and machinery in class 3, you are correct. You understand? You are correct. Because you are assuming that it is not for planting, it's not for manufacturing purposes. But I am also assuming that this company is a manufacturing company. So please, if you put it in class 3, you are correct. If you put it in class 2, you are correct. To avoid doubt, when you finish your computation, write under it assumption. I'm assuming that the plant and machinery is not for manufacturing purposes. That is why I put it in class 3, and you are correct. Any question? Good. If no question, let's proceed. Now, they said that what? The business commenced, the Kama Limited commenced business on 1st March 2020. 1st March, and in capital allowance, it is the day you commence business, it is on that day that you start computing capital allowance. It is not when you bought the asset. It is the day you commence business. Are you okay? So let's go. We take the first one, 80,000. So what is the percentage? What the capital allowance percentage, please? What is the percentage?
40%.
Good. So it will be
40%.
capital allowance for this one will be 80. Oh, sorry. 80,000 times. Let me do the working now. Let me do the working stuff.
But sir,
So
in
it will,
exam condition, can you go straightforward or you have to do this workings?
no, you can go straightforward though. Okay, or you can still working, okay. But you can go straightforward. I was trying to squeeze it somewhere, but I'm not getting space. 40% times. So they started the operations in March, right? So March has how many days? March has how many days? 1st March. So the full of March. Is it 30 or 31? 30 days.
30.
March has
31.
31.
Hey, please learn how to say 30 days as September, April, June, and November.
And
All the rest are see also.
51, yeah.
See also. 30 now going 31. Wait to you. And February use 28 days. That is standard days. Are you okay? Good. So let's go. March is 31. April is how many days?
Why not calculate the ones
Yes,
that
calculate
cannot be
January and then
included
February
and
And subtract it,
deducted?
eh?
Yes.
Okay, I think that makes sense. That makes sense. So please, when you did it, what did you get? So the 365 or 366?
It will be
Which one?
306.
You got 306.
Yes.
Yeah.
Please, how did you get a 306? Help me.
365 minus the 59.
Yeah. 59. 59 is for
Sorry.
January and February.
Yes.
Oh, Majuma B. That's good. That's good. So 300 and divided by 365. Is that also?
Yeah.
Correct.
That will give us the capital allowance for class 1. Answer.
26827.
26827.
Yeah.
Perfect. Perfect. You are correct. Let's go to class 2. Good. Class 2, we have 1,895,000. 1,895,000 times 30% times 306 divided by 365. What do you get?
476605.
Class 3. Class 3, we have 138,000. 138,000 times 20% times 306. This is what. This is what you get.
23139.
Perfect. The last one, class 4. We have.
Sir,
Please ask a question.
please, how did we get the 306 days?
Okay, please, I'm coming. I will explain to you. Answer, please.
209589.
That's the capital allowance. Now, madam, let me explain to you how you got it. Madam, this is what is happening, okay? So for capital allowance, the formula is A times B times C divided by 365. A is the value of the total assets. B is the percentage, and C is the total number of days you'll be working in the year, the basis period, the number of days you'll be working in the year. I believe you understand. So you only use this formula if you are now starting operations. If you are now starting operations, that is when you use the formula strictly. You strictly use the formula. Apart from that, they just multiply it by the percentage and you are good to go. But if you are starting operations, that is where you what? You strictly follow the what? The formula. Are you okay? If you're now starting operations, so as you can see, they are saying that what? We are now beginning operations. Operations started on 1st March. Operation started on 1st March 2020. Operation started on 1st March 2020. So you ask yourself, so from 1st March to 31st December, how many days is in it? 1st March to 31st December, how many days are we working for the year? So you add in March, how many days is in March? In February, how many? In April, May, June, July, August, September, October, November, December. So ask yourself, how many days is in March? How many days is in April? How many days is in May? How many days is... So you work here, you use the asset for all these months. You use the asset for all these months. So when you finish, you add the total number of days you use the assets. So you realize that from March to what? December, it is 306 days. That is why I wrote 306 divided by 365. Because we are beginning operation in 1st March. We are not using the asset for the entire year. We didn't use the asset in January. We didn't use the asset in February. We started using the asset in 1st March. So for March to December, how many days is in it? So that days we divided by 365 times the value of the asset times 30%. That is big because it is class 2. If it is class 3, it is the amount of the total asset times 20% times 306 divided by 365. Just because we are starting operation in 1st March. Assuming we are starting operation in 1st June, I would have added the total number of days in June, total number of days in July, total number of... Do you understand it? Perfect. Madam, do you understand it now?
Yes, sir. Thank you.
But after the 1st year, the 2nd year, you know that because the assets are already existing, so we will use it for the entire year. So that one to be 365 divided by 365 be the same as 1. So if you like, you don't even bring it at all. Madam, but what you understand?
I try. Thank you.
But for the 1st year, you have to know the number of days you are using it in a year. That's why we did it that way.
I see. Thank you.
You are welcome. So you have to know 30 days as September, April, June, and November. So that if you miss any one day wrong, once and you not get a perfect answer. Okay. So please. So they were saying that your colleagues were saying that, oh, sir, because we used the asset in from March to December, we didn't use it in January and February. Why don't you find the 2 days, the total number of days for January and February, and subtract it from 365? The total number of days in January and February is 59. Subtract it from 365. We end up getting 306. So 306 divided by 365 no. Quick. Rather than for us to go and do March, April, May, find January and February, subtract it from 365. You still get an answer that you get. So that's what we did.
February, you use 28 or 29?
February always use 28. Are you okay? If you use 29, then you are talking about a leap year. So you have to make your total number of days to be 366. If you use a leap year, oh, yet February 29, not just the total number of days, no, it's not supposed to be 365. It's supposed to be 366. Madam Pacha, what I say? So to avoid trouble, use 28 days and you make the total number of days to be what? 365. Madam, you don't understand. The network is not good. So now that I have the answer there, I'm just copying the answers into Okay. So this is for 2020. So 2021, you have balance brought down. Someone say written down value. Written down value or balance brought down. Anyone is correct. Are you okay? Let's make it written down value. That is more technical. Written down value. Written down value. Okay. So just repeat it because 11486 290,411. You get it. So we have addition. If there's any addition, did they buy any new asset? So let's go. The following additional assets were acquired by the company in 2022. 2022. Oh, 2021, they didn't buy any assets. So if they didn't buy any assets, means addition is dash, addition is dash, addition is dash, addition is dash, addition is dash. So you have to calculate capital allowance for the year. So 40% times this. You understand it? 40% times this, 30% times this, 20% times this. You are assuming it to be this one. So please, kindly give it to me.
21269.
Okay, next one.
425519.
Okay, this one.
22972.
22972.
250,000.
Yeah. Oh, this one, it is on a straight line. So it's
Yes,
always
on the cost.
the cost. You understand? It's on a straight line. So this one is not a reducing balance. So it's always on the cost. Class 4 and class 5 is always on the cost. If you know that one, you are free. Good. Yes, what do you get?
31904. 992876.
992876. Yeah, this one.
91889.
Yeah, this one.
2040411.
Perfect. So let's go 2022. So 2022, you bring it down. Okay, written down value. So this is balance carry down or written down value carry forward. Written
sir,
down value carry forward.
please, Toyota saloon car was purchased on 30th September. Why
And that
did
was
this?
2022.
It was 2020. The one on the Toyota
And this
saloon
one.
car. And
Is it
30th
this one?
September 20, yes, please.
Perfect.
The 180. So why did we still subjected to the 306 days?
Oh, no. Listen, I said, in capital allowance, hey, this is a basic principle. In capital allowance, you only use the day the company started operation, not when the asset was bought. Are you okay? You only calculate it based on when the company started operation. So the company started operation on 1st March. That's why we are using 306 days. Because the company started operation in 1st March, not when the asset was bought. For accounting, fine. But for tax purposes, it's only capital allowance is on the day the company started operation. And it started operation on 1st March. My boss, are you okay now?
Yes, sir. Yes, sir. Okay.
Not when the asset was bought. If not, but for accounting purpose, they're fine. But for the taxman, he uses when the company started operation. That is why we only use the number of days on the 1st year. But 2nd year go, you don't use the number of days again. Perfect. Hey, you question say, and I just say, oh, your foundation is weak. Nabu beer. Okay, good. So written down value. say 104 992 876 91889 2040411. Cool. Now let's go. So footnote. The following additional assets were acquired by the company in 2022. We have 105,000 and we have 78,000. So computer 105. So let's go and add it. Computer 105, office equipment 78. Addition. Please 10 what? 5,000, right? And office equipment is as 3. You add it nicely like that. Okay, continue. What's next? It says on 1st October, the same 1st October, 31st October 2022, the Toyota car was involved in an accident and was completely unrepairable. The company received compensation of 120,000. So when you receive compensation of 120,000, it's as if you have sold the car for 120,000. You understand it? So disposal 120,000 because it is class 2. 120,000. So that is that. We can also say, let's see, there's more science in this there. Let's continue. The profit will, okay, that's it. So relation to the capital balance. Please add this one for me. 10. So who?
904.
Okay, 136.
904.
Okay, 136. 904. Yes, please what about this?
872876.
Okay, good. Please what about this?
169889.
Please what about this?
The same 24041.
20411. Good. Now let's calculate capital allowance. 40% of this.
54762.
54762.
261863.
This
978.
This 250,000, right?
50,000. Yeah.
That's the same thing. Now written down value. Carry forward. The one you are carrying.
82142.
Was it?
82142.
Okay, 82. Okay. 82 142.
611013.
Good.
135911. And 17904111.
Okay, good. Area. So that's it. Capital allowance area. So if they ask you, so capital allowance, I will add this, and add this. That is the capital allowance for 2022. Add this, and add this. That's the capital allowance for 2022. For 2021, there's the capital allowance. Add this, and add this. That's the capital allowance for 2021. And in 2020, add this, and add this. This is the capital allowance. Are you okay? Good. Yeah, now look at the following question. I'm saying the following profits were declared by the company. Just profit by the company. But so I'm saying compute the capital allowance and accessible income of the relevant year. So this is 2020. So 2020, 600,000. Subtract less capital allowance. Subtract capital allowance from it. You get your income. You get accessible income. This one to 1,500. Subtract your capital allowance from it. This one to subtract capital allowance from it. That's all. That's the solution for it. Anyway. So that's it. Okay. So thank you so much. This is the answer we got. So capital allowance for the 20. Total capital allowance. So the income, subtract the capital allowance from it anyway. Oh, what it? There's the capital allowance. What if you remove? Subtract capital allowance from it. This one subtract capital allowance from it anyway. Agbena. Now let's go to the next question. The next question, question 2B. Question 2B. It says the management of Chika PLC, a United Kingdom-based company, is considering the possibility of launching a presence into Ghana, and it is not too sure of the tax implication with the following. Good. Now they say you should advise him on this. It is considering making its presence through incorporation in Ghana, that is registering as a company, or create an external company that is a permanent establishment, into bracket branch. So please, they're asking you, somebody wants to launch a business in Ghana, but the person is contemplating as to whether you should launch the company in the form of a branch, or you should launch the company in the form of what? An incorporated company in Ghana. An incorporated company in Ghana means that a subsidiary, a limited liability company. So between these two, which one is good? You remember I've given this to you in your notes, right? You should know the distinction between a branch and a subsidiary. Know the distinction. I beg you. Know these two clear difference. It can come. Take it serious. Distinction between a branch and what? A subsidiary. Are you okay? Perfect. Next one. It intends to acquire all non-current assets. So this one I'll teach you. Yes. I'll teach you the tax implication of finance lease. The tax implication of finance lease. I'll teach you. Yes, I'll teach you. In the course of it, I will intentionally teach you, then you'll be able to do this. The next one, it intends to bring some staff from UK. The third one, it intends to bring some staff from UK, work in Ghana, who will be paid half salary in Ghana and half salary in a different country. Remember, when you are working in Ghana, it means that you are getting your income from Ghana as a source country. So if you bring a staff from UK to come and work in Ghana, it is in Ghana that they are getting their what? Their income from. Therefore, Ghana government will tax them based on their what? On their total income. He will charge them, Ghana government will charge them tax based on their total income. I believe you understand it. So when you come to employees, the country in which you are working, that's where you pay your tax. So therefore, if you are bringing a staff from UK to come and work in Ghana, Ghana government will charge them tax. Why? Because they are getting their income from Ghana. Ghana is being the source. So let's go at the solution. The first solution here, when you establish a business in the form of an incorporated company or subsidiary, this is the tax implication. And as a permanent establishment, this is the implication. Then the difference, no, the one that is better, this and this, no, the one that is better, this and the one that is better, this and the one is better, the one that is better, the one that is better. Do you understand it? Perfect. Yeah, we. Now, next one. As I'll teach you. Then I. Resident or non-resident individual who earn income in Ghana. Once you earn income in Ghana, will be taxed on the full amount of income earned in Ghana. Thus, the staff to be brought to work in Ghana will be taxed on the full income earned in Ghana, regardless of whether half of the salary is paid in Ghana and half is paid abroad. Do you understand it? Their tax status will be regarded as residents once they are present in Ghana for a period or periods exceeding 183 days or more in an aggregate period of year. If you have any question, you can this, or you don't understand. You understand. So wherever you get your once you are getting, whether you're resident or non-resident, once you are getting your income from Ghana, this one is employment income, not business income. This one is employment income. Once you are paid salary in Ghana, once you are working in Ghana, you are paid salary in Ghana. You pay your tax to Ghana government. But if you're a business, you pay your tax to Ghana government. If you become a resident, I believe you understand. If you're not a resident, you know. But if you're an employee, once you get your income from Ghana, you pay your tax. You understand it? And you become a resident if you spend 183 days in Ghana from the beginning to the end of the year on aggregate terms. Now let's go to question 3. Very important. I love this question. This is the question that came last night. A similar one came last night. The same concept. So let's go. A Nigerian investor, into brackets, Niger Limited in Ghana, has the following relating to its business. Always take note of the date. This is 2020 and this is 2021. Can you see that? 2020, 2021. So we have revaluation reserve. Revaluation reserve. Do you know revaluation reserve? When you do revaluation surplus, that's the revaluation reserve. Revaluation reserve. In 2020, it was 100,000. In 2021, it was 250,000. Revaluation reserve. Now, share capital. In 2020, it was 600,000. In 2021, it was what? 1 million. This is the last one we close, okay? Retained earning. In 2020, it was 1,350,000. In 2021, it was 1,200,000. Revaluation reserve has increased. It was 100. It has gone to 250. Can you see that? So this is what it means. When you see 2020, 2021, what it means is that when the tax auditor came in 2020, your revaluation reserve was 100,000. But when he came in 2021, your revaluation reserve has gone to 250,000. This revaluation reserve is not actually earned yet. It is not actual money. It's not actual money. It's just notional increase in your assets. Notional increase in your assets. So when your asset value increases, the revaluation surplus, no, you're going to register, you're going to report it in your balance sheet as revaluation surplus or revaluation reserve. And that is what you're having here. So what this means is that in 2021, their assets increased by 150,000. The value of the assets increased by 150,000 because formerly it was only 100,000. But currently it is now 250,000, meaning that there has been an additional 150,000. So in 2021, the value of the assets increased to what? 250,000. Are you okay? So that's what it means. What the tax implicates? It has no tax implication because this money is not real money. But let us say, so when your revaluation surplus increases, it has no tax implication. You not say that your revaluation reserve has increased or your revaluation surplus has increased. So you're going to pay tax on the increase. Nonsense. They don't do that. Because you have not actually earned the money unless you sell the assets. So this revaluation reserve, no, it's just an increment. You should be recording it in your books. If you sell the assets, then obviously the money you'll get. But until you sell the assets, you have not earned the money yet. So this one, you don't pay tax on it. Look at something. Share capital has increased. So the shares of the company has increased from 600,000 to 1 million. That's the meaning of share capital. The shares. It's been a company floated shares. And it has increased. So it floated shares. Now, there is a tax implication when you sell shares. For the taxman, once your share capital has increased, it means you have sold shares. They don't care where it came from. It means you have sold shares. There's a tax implications when you sell shares. The tax implication is that anytime you sell shares, okay, you are supposed to pay tax of 0.5% on every share. Anytime you sell shares, so if your share is 2 cedis, that 2 cedis, no, you are supposed to pay tax of 0.5% on it to the tax authority. That's tax implications of what? Selling shares. Are you okay? So the tax implications of shares increase is that you have to pay tax of what? 0.5% per share. What name is given to that? We call it stamp duty. We call it stamp duty. Perfect. Emmanuel said you are good. We call it stamp duty. You pay 0.5% per share to the government. It calls stamp duty. You have to pay tax on stamp duty. That's 0.5%. I'm telling you this, so pay attention. So in the year 2021, you see that it was 600, it has gone to 1 million, meaning that 600, no, would take 1,000 more, back 400. So it means that the company sold shares worth 400,000 for that current year. So they have to pay stamp duty on it. Stamp duty tax on it. Stamp duty tax on it. That is 0.5% times 400,000. It's not 0.5, oh, it is 0.5%. So 0.5 divided by 100, less than 1%. 0.5 divided by 100 will give you 0.5% times 400. How much? 200. So they're supposed to pay tax of 200,000 cedis. 200,000. That's if you bring the 3 zeros. Are you okay? You're supposed to pay tax of 200 to the government of Ghana. So they ask what is the tax implication? Did the tax implication? Oh, tax implication in you. So GRA comes to a company. They'll be requesting for a financial statement.
So
yes.
0.5% of 400. If we make it 200, then it's 50%.
So please, can you calculate this for me? 0.5 divided by 100 times
It's
400.
200, not 200,000.
Hey, okay, as in 200. As in, if you include the 3 zeros, is that the case?
If you include the 3 zeros,
it will be 2,000.
2,000.
It will be 2,000, yes. So please, to avoid trouble, always make it 0.5 divided by 100. The answer you get, no, they multiply by the total number of increments. Are you okay? Or total number of shares that has
Or what
increased.
about 0.05?
No. 0.05, no, you're correct. That one is 5%.
Okay.
This one is supposed to be less than 1%. So always make it 0.5 divided by 100. Or
Okay.
you can make it 0.005. Are you okay?
Okay.
Yes,
Thank you.
0.005. Just make it 0.5 divided by 100 times the amount of share increment. And the amount of share increment. It means that the particular year, 2021, they sold shares worth 400,000. So 400,000 shares they sold, you are supposed to pay stamp duty of what? 0.5% to the government of Ghana. And you are correct. Maybe I've told you about this. Now, this is where their focus is always on retain earning. So retain earning. Now, you listen. Sometimes when companies do not want to pay tax, they don't want to pay the withholding tax of 8% on dividend. They will tell Commissioner General that you are not distributing the retained earning. You are keeping the income as retained earning for the company. You are not distributing it. Oh, it's not going to pay the shareholders. You know that if I pay shareholders, I have to charge or withhold tax of 8%. If you want to dodge, then don't pay shareholders dividend, but rather keep the money as retained earning. So Commissioner General too will take note of your previous retained earning. Next time when they come and audit you, they'll look at the retained earning. All other things being equal, the retained earning is supposed to be the same, unless you have evidence that you use it for the business purpose. In fact, the retained earning is supposed to be the same. The retained earning is supposed to be the same. So if they come to a company, okay, last year retained earning was 1.35 or 1,350. This year, retained earning has gone to 1,200. Last year, it was 1,3250. This year, it is now 1,2. As you can see, the retained earning has reduced. So, Commissioner General will assume that you have the difference, no? You use it to pay dividend. That's what Commissioner General will assume. That, hey, you use that to pay dividend in order for you to pay 8% withholding tax. No? So you say you will not declare dividend. Hence, you are keeping the money in the company. Now, why has it reduced? Because the money there, no, once you remove some from the retained earning, you are supposed to pay withholding tax on it. Because this money, you are supposed to pay withholding tax on it of 8%. But you say you are keeping it. So once you are keeping it, you need not remove it. If you remove even 1 cedi from it, then you have to pay the withholding tax that you're supposed to pay. You're supposed to pay it on it. I believe you understand it. So for retained earning, if Commissioner General comes and the retained earning has reduced, you pay dividend on it. And that, when you do that, we call it deemed dividend. Commissioner General will deem it as if the difference, no, you have used it to pay dividend, even though he was not there. So he will say that what? I'm deeming it as if you have paid dividend. I believe you understand. So we call it deemed dividend. Commissioner General will assuming that what? You have used the difference to pay dividend. So what is the difference? So last year it was 1,350. This year it is 1,200. So the difference was 150. Can you see that? So this 150,000 that has reduced from last year retained earning. Commissioner General will assume that this one is a deemed dividend. So deemed dividend now just say you pay 8% withholding tax on it. So he will charge you 8% on the difference. The difference, he will charge you 8% on it. And that is the deemed what? Dividend. Are you okay? That's a
Yeah,
deemed
what
dividend.
if it was used to purchase an asset?
What if it goes
Let me tell you
down?
something. Please let me tell you something. If you make profit for the year, you are supposed to share to the shareholders. True of us.
Yeah.
If you make a profit for the year, you are supposed to share to the shareholders. Now, when you are sharing it to the shareholders, you are supposed to withhold tax of 8%. Please, true of us. Oh, please respond.
True.
You are supposed to withhold tax.
True.
Now, if you don't want to pay the tax of 8%, you tell Commissioner General that I'm not paying dividend this year. So therefore, if you're not paying dividend, that means that you are retaining it as retained earning. No wahala. Commission General will not fight with you, but rather they will take note of the amount. Next year, if they come and the amount has reduced, the Commissioner General will deem it. He will assume that the money, the difference, you have used it to what? You have given it to the shareholders indirectly. That's the only assumption. Because that money, you are supposed to give it to them. But I say you don't give it to them. Okay. Now, indirectly, you have given it to them. So if he comes and there's a reduction in the retained earning, he would deem it as if you have used it to pay dividend. It's a deemed dividend. Are you okay? So the reduction, Commissioner General will assume that you have used the difference to pay shareholders. Hence,
So
you
what
charge the
if
return
it goes up?
What I'm talking about if it goes down.
Yeah, I want the opposite. In
Okay,
case
if
we
it
have
goes up, it cannot go up. If it go up there, then you have to explain how it got up. It will never go up. Because last year I came, it was 1350. This year I've come, it has gone to 1500. Tell me where you got the 500 from, or the increment. Where did you get it from? Because last year and this year, it's not as if you've gotten a profit and you've added it. So not just say your financial statement you prepared, you didn't prepare it well. So all along, we are using the wrong financial statement. Madam, do you understand it?
No.
Okay, good. This is what it means. Madam A, last year, your retained earnings is 500 cedis. 2020. 2021, if Commissioner General comes, you said your retained earning is 600 cedis. Meanwhile, you have not added the income for the year to it. You've not added the income for the year. Income for 2021, you have not added it to it. So my question is, the 100 cedis increments, or you don't understand?
So sir, I mean it's been prepared before the financial
two different years.
Come again?
I thought they were two different years.
There are 2 different years, and I'm saying that the profit for the current year, you have not added it to retain any yet. The profit for the current year, you have not added it to retain any yet. So last year it was 2020. This year it has gone to 2021. Where did you get the 100 cedis from?
Oh, the return earning for 2021. Is it not a different
You have not included it. I'm saying you have not included that one to it yet.
Okay.
No, you have not included the return earning for current year. You've not added it. This year you made 50 cedis. You've not added the 50 cedis to it. That one you decided to pay it off as to the shareholders. So can you see that it can never go up?
Yeah, per your explanation. But I was thinking that there were 2 different financial years. So return earning for 2021 is different from return earning from 2020.
Who say return earning? It doesn't return earning. It increases. So you'll be adding up. Balance sheet, it increases. Balance sheet. You can't say that last year, 500, this year, 600. So there are 2 different figures, Dabi. So whatever you get for this year, you have to add it up. So this, you see,
so it means that the tax man comes before the current profit is added to the retained earnings.
No. That's not. I was just giving a scenario for you to get the broader concept. Are you okay?
Okay.
Now, okay, this year you made a profit of 50 cedis. This year. So last year it was 500. This year you made a profit of 50 cedis and you have added it to retain earning. You are supposed to get 550. So how did you get 600? That 50 cedis now account when you're loan. Loan, you are not supposed to report loan here. You have a place to report loan. It was revaluation surplus. Revaluation surplus, you have a place to record revaluation surplus. So the retain earning, it can't go up. Retain earning, it can't go up. Unless you sell shares. If you sell shares too, you have a place where you record selling of shares. What I'm trying to tell you is that for essence purposes, usually it will reduce. Retain earning will reduce. Like I say, the money you are supposed to pay to shareholders as, if anything, the money you are supposed to pay to the shareholders as, if anything, their dividend, because you don't want to pay the withholding tax on dividend on it, because you don't want to pay withholding tax on dividend on it. So you smuggled it in a way. You told them that, oh, I will retain it. Now when the tax man goes, then you give it to them. So when the tax man also comes, you say that the reduction, I'm assuming that you have paid it to shareholders as dividend. Hence, we will charge you 8% on it. Are you okay? Now, if the money from the retained earning, you used it, you used it to buy shares or use it to expand your company. Maybe you remove money from retained earning to expand your company through shares. Can you see that? The retained earning, you use the retained earning money to buy shares into the company. Are you understanding? The tax man, he will charge you the 8% for removing money from retained earning, and he will charge you stamp duty. I'm assuming that, okay, fine. When the tax man comes, you tell me that, oh, the money from retained earning, we use it to buy shares because we didn't want to float shares. If we float shares, there'll be other people who would like to have control in the company. So we diverted the money from retained earning to expand the company in the form of shares. So therefore, the tax man no there. Because okay, fine. I'm assuming that the shares, no, it is an outsider who is buying it. And hence, I'm charging you 0.5% as stamp duty. And you removing money from retained earning, you are paying 8% on the money you have removed because I'm deeming it as if you have used the money to pay dividend. It's as simple as that. Are you getting the concept? This is the only thing they will test you. This is the only thing they will test you, Asa.
Hello, sir.
Please come in.
Yeah, please. Does it mean that the tax authority don't support or don't allow plowing back of profits?
They allow plowing back of profit, but so if you tell them you are retaining profit, they don't have any issue with you. Assuming you told them that retaining, so last year retained earning was 1350. When it comes this year, it is 1350,000. They don't have any issue. Are you okay? They don't have any issue because.
So let's assume last year the profit that we made 1350. This year we made profit of, let's say, 100, and we
100.
take part of last year profit plus this year profit to plow back.
Plow back to do what?
Maybe
to
we've gotten
shares. Okay,
a viable venture that we need to invest in. Maybe buying asset that this year loan profit cannot buy. You need to take some of the retained earnings to add.
Perfect. So you are using to buy assets. Is that the case?
Yeah.
In a different company, right? So you buying assets in a different.
We are buying assets to use in our own company.
For this current company. Okay,
yes,
good.
Sir.
So the tax implication for this is that you removing money from the retained earning, you pay tax of unimibi. And you are making this thing so practical that you want to forgo the tax effect. And you want to forgo the tax effect. And trust me, it's guiding you to score marks. I'm not very practical as how. So for but then I understand you. You get it. I understand you. But once the principle is that once you remove money from retained earning, you are supposed to pay dividend on it. Okay, assuming you share the money, my boss, assuming you share the money last year, assuming you shared it to the shareholders and you want to buy this asset, will you not collect money from the shareholders to buy this asset you want? Let's assume that the shareholders don't even have money. Will you not float shares for you to get money? Hello?
Yes, sir.
You float shares to get money. So when you float shares, the 0.5% tax applies. Assuming you shared the retained earning last year, this one also applies. Assuming you shared the earning last year, okay, the 8% withholding tax on dividend also applies. I believe you understand. So please, always share it. Are you okay? Always share it. If you don't share it, then when you are removing from retained earning, you have to, because what they want to avoid is that, this is why they do that. What they want to avoid is that, assuming they encourage you, when you remove from the retained earning, they'll say that, okay, fine, you remove from retained earning to expand the business, or you remove from the retained earning to buy assets. So because of that, we will not charge you any tax. What will happen is that in the near future, almost every company will say that we are not sharing the dividend, but rather we are using it to expand the business. So when the taxman goes, they will share the money among themselves. When the taxman comes, they tell the taxman, oh, we use the money to buy assets for the company. You get it? But because of this strict principle, so anytime you get dividend, you either get profit, you either share it, or if you put it in retained, you don't touch it. But once you touch it, be prepared to pay the 8% on it. So that's the principle. Just get the principle. Are you okay? Thank you very much. So the next question. What is the tax treatment for research and development? That one we all know. explain the condition under which interest is deductible. Okay, this one we just did it. This one, the interest should come from a loan that was procured wholly, necessarily, and exclusively for the business. You understand it? If the interest is gotten from a related party, the loan was gotten from a related party, then arm's length standard must be applied, and also thin capitalization rule must be what? Applied. That's the rule regarding what? Interest. Are you okay? But interest is an allowable expenditure, provided you meet this condition. So simple, right? Always, any allowable expenditure should meet the when, wholly, exclusively, and necessarily condition. So look at the solution. So the solution, look at on say, tax implication of transfer of retained earning to share capital. So the transfer of 150,000 from the retained earning account for stated capital is deemed dividend. Can you say that? Deemed dividend. This implies that the tax at the rate of 8% shall be imposed on the transfer, the tax of 8% on the difference. And we using it to buy the stamp duty, there shall be stamp duty tax of 0.5%, which is 0.5% times this. What as it's kind of you used to buy stated capital. So therefore, you withdrawing the money more. Deemed dividend, that is 8% will apply. Then you buying the shares, no, that one to stamp duty of 0.5% will apply. Full stop here. Then the treatment will see. So I have already shared this material with all of you. Please, this brings us to the end of today's class. In fact, it was a very fruitful class with all your suggestions, very perfect suggestions. That's so good. In fact, the last questions were so good. I love you all. Thank you very much. We'll meet. Yes, please. We'll meet about system. Kwejuma. About system Kwejuma. So we'll meet, God willing.
Hello, I want to ask a question.
Kwejuma about system Kwejuma.
Yes,
sir.
okay.
Okay.
I want to ask a question.
Okay, ask your question, please.
Yeah, my question is the stamp duty.
A stamp duty.
It has been reduced to 1% or is still 0.5%.
Okay, for now, can you use the 0.5%?
Okay, thank you. But in reality, is it reviewed so that when we are doing practical, assuming you are going to GRA and you are going to Registrar General, is it 1%? It's still 0.5%.
Please, do you have any document to that effect? Usually, if they review a law, you understand it. If they review a law, it takes some time before we apply it. But if you have a document that is saying that the implementation has begun, you can bring it so that we consider it. Are you okay?
I can't testify now with any document. But
if they read it in this one, it has not taken effect. When they read it as part of the budget, it has not taken effect until you see the application date. Are you okay? So get us the document that shows that it has taken effect, they will consider it. But for now, let's use the 5%. God bless you.
Thank you.
Thank you all, please. We'll meet, God willing, Wednesday, next week, Wednesday. Thank you. Bye-bye. But please, my students, we are meeting. Okay, today is Thursday. Sorry, we meet Thursday. Done. Okay. But my students, we are meeting. What suggested? Now, suggested saying nonsense. Okay, good. You're not the one waking. You know how I suffer to wake up and do. Okay, please, my students. Amen. So please, my students, we are meeting at 5 o'clock a.m. on Saturday for our normal class. We are continuing with that. Thank you very much. We meet on Thursday. Bye-bye.